You're gonna what? What? What the hell you would pump and dump for? Hey, what's going on, Profit Bulls? The pump and dump scheme. Yo, it's Dom here. Hear me out on this. I'm going to elaborate what pump and dumps are. A pump and dump is a scheme that attempts to boost the price of a stock through recommendations based on false, misleading, or greatly exaggerated statements. The perpetrators of this scheme already have established a position in the company's stock and sells their position after the hype has led to a higher share price. This practice is illegal based on security law and can lead to heavy fines. The basics of pump and dumps schemes were traditionally done through cold calling, but with the advent of the internet, this illegal practice has become even more prevalent. Fraudsters post message online enticing investors to buy a stock quickly with the claims to have inside information that a development will lead to an upswing in the share's price. Once the buyers jump in, the perpetrators sell their shares, causing the price to drop dramatically. New investors then lose their money. These schemes unusually target micro and small cap stocks as they are the easiest to manipulate due to the small float of these types of stocks. It does not take a lot of new buyers to push a stock higher. Pump and dumps, the same scheme can be perpetrated by anyone with access to online trading account and the ability to convince other investors to buy a stock supposedly are ready to take off. The schemes can get the actions going by buying heavily into a stock that trades low on volume, which usually pumps up the price. The price action induces other investors to buy heavily, pumping the share price even higher. At any point when the perpetrator feels the buying pressure is ready to fall, he can dump his shares for a big profit. The pump and dump in pop culture scheme formed the central scheme of two popular movies, Boiler Room and The Wolf of Wall Street, both of which featured a warehouse full of telemarketing stockbrokers pitching penny stocks. In each case, the broker firm was a market maker and held a large volume of stock in companies with highly questionable prospects. The firm's leaders incentivized their brokers with high commissions and bonuses for placing the stocks in as many customers' accounts as possible. In doing so, the brokers were pumping up the price through huge volume selling. Once the selling volume reached critical mass with no more buyers, the firm dumped its shares for a huge profit. This drove the stock price down, often below the original selling price, resulting in a big loss for the customers. Because they could not sell their shares in time, pump and dump schemes investors should be wary about. Notice that a stock is about to take off, especially when they are unsolicited. No matter how tempting it may be, consider the source and check for red flags. Many notice come from paid promoters or insiders who should not be trusted. If an email or newsletter only talks about the hype and does not mention any of the risk, it's probably a scam. Do your own research pretty much. Let me know in the comments below what you think pump and dumps are. If you haven't yet, hit the like button, subscribe if you haven't. Until next time.